Imagine you're at the helm of a growing company. You're excited about the future, but you quickly realize that managing money is not just about tracking what comes in and what goes out. As a financial manager, or even as someone just trying to understand the financial side of a business, you'll find yourself constantly circling back to two fundamental questions. These questions are not just for big corporations. They're relevant for small businesses, startups, and even personal finance on a larger scale. The first big question is this: what long-term investments should the company make? Think of this as the investment decision. It's about deciding where to put the company's money to generate future profits. Just like you decide where to invest your personal savings, a company needs to make strategic choices about its assets. These investments could be tangible things, like new factories, updated equipment, or even expanding into a new office space. Or they could be intangible, such as investing in research and development for a new product, launching a major marketing campaign, or acquiring another company. Consider a coffee shop chain. They might be thinking about opening new locations. This is a major investment decision. They need to analyze potential locations, estimate the cost of setting up a new shop, and project how much revenue it might generate. Will this new store be profitable and contribute to the company's growth? That's the core of the investment question. Financial managers use various tools and techniques to analyze these opportunities, weighing the potential return against the risk involved. They look at things like projected cash flows, profitability, and how the investment fits into the company's overall strategic goals. It's like carefully choosing which seeds to plant in your garden. You want to pick the ones that are most likely to grow into healthy, fruit-bearing trees. Poor investment decisions can lead to wasted resources, missed opportunities, and potentially put the company's future at risk. Smart investment decisions, on the other hand, can propel growth and create long-term value. The second crucial question is, how should the company pay for these investments? This is the financing decision. Once you've decided what you want to invest in, you need to figure out where the money will come from. Companies generally have two main sources of funding: debt and equity. Think of debt like taking out a loan. The company borrows money, usually from banks or by issuing bonds, and promises to pay it back over time with interest. Equity, on the other hand, is like selling a piece of ownership in the company. This is typically done by issuing stock. Equity investors become shareholders and share in the company's profits and losses. Continuing with the coffee shop example, if they decide to open those new locations, they might need to borrow money from a bank, issue bonds to investors, or even sell new shares of stock. Each of these financing options has its own set of advantages and disadvantages. Debt can be cheaper in the short run because interest payments are tax deductible, but it also increases the company's financial risk because they have a fixed obligation to repay the loan, regardless of how well the business is doing. Equity financing doesn't create a fixed obligation, but it dilutes ownership and can be more expensive in the long run if the company is very profitable, because shareholders will expect a return on their investment. Financial managers need to carefully weigh these financing options and decide on the optimal mix of debt and equity, often referred to as the capital structure. They need to consider factors like interest rates, market conditions, the company's risk profile, and its long-term financial goals. A well-thought-out financing strategy ensures that the company has access to the necessary funds at a reasonable cost, without taking on excessive risk. Just like choosing the right tools for a job, selecting the appropriate financing method is vital for a company's financial health and its ability to pursue its investment plans effectively. These two questions, investment and financing, are deeply intertwined and form the core of financial management. They are not isolated decisions, but rather two sides of the same coin. Making smart choices about both is essential for a company to thrive, grow, and create value for its stakeholders. By continually addressing these fundamental financial questions, financial managers guide companies towards a sustainable and prosperous future.